right, let's get started with the second paper of the day. So thank you everyone for all the great comments and questions in the first session. We are excited to have Feng Gu here from University of Buffalo presenting his paper, All Losses Are Not Alike, Real versus Accounting-Driven Reported Losses. So Feng, you have 20 minutes, the floor is yours.
Okay, thank you, John. Thank you for your introduction. First of all, we would like to thank the editors of Real Accounting Studies and organizers of this conference for accepting our paper for presentation. It's a great honor to be invited, and we look forward to the comments from our discussant and conference participants. Before I start, I would like to acknowledge the invaluable contributions by my co-authors, Brooke Leff from NYU and Chen-Chi Zhu from UC Irvine. Without their collaborations, this paper would not be possible. Chen-Chi is sitting in the audience with us. She's helping me with taking notes. As our title indicates, we examine loss firms and the loss reporting. Our study is motivated, trying to just click through this. Okay, oh yeah, here we go, too fast, yeah. Okay, here we go. Our study is motivated by the continued increase of loss reporting over time. As shown in this graph, the frequency of loss reporting and the amount of accounting loss have continued to increase in recent decades. In 2019, which was the peak of a long economic boom, nearly half of public companies were reporting losses. In the more vibrant and faster growing technology sectors, loss percentage was even higher, standing at nearly 70% in 2019. The amount of loss relative to firms' total assets has also been increasing over time, reaching nearly 20% for all loss firms and 40% for technology firms in 2019. It is really surprising to have a high percentage of firms reporting large amount of loss in a booming economy. And by now, the intriguing fact that 50% of firms suffer loss in a boom year of 2019 has been reported in the media, and even the SEC is aware of it. A very similar trend also exists in UK and EU countries. So the persistent growth of loss reporting is a global phenomenon. In accounting research, there's a long-standing literature examining loss firms and loss reporting. This literature provides two important insights. First, starting from Hain 95, numerous studies have found that loss is less informative than profit. Several studies confirm that loss has very low value relevance, even in the presence of other information. So the lack of information content in accounting loss is a very robust result and has been taken for granted by accounting researchers for more than 25 years. It is now a standard practice for researchers to include a dummy variable for all loss firms in their research design. Another important insight from the existing literature on loss reporting is the liquidation abandonment option hypothesis. All studies on loss firms, starting from Hain 95, pretty much conclude that liquidation abandonment option explains the lack of information content in accounting loss, because investors will eventually react to losses by liquidating loss firms. Losses do not convey the same information about future cash flows and firm value as profits do. And multiple studies have provided evidence supporting this liquidation-based interpretation. For example, this study by Peanut and Lillies in 2007 accounting review find that loss firms have more employee layoffs than other firms. In our study, we examine loss reporting from a previously unexplored perspective. We focus on several major intangible investment items that drive the growing frequency and the magnitude of accounting loss. So why intangibles? Here's the reason. So this graph shows a fundamental shift in US private industry investment trends over the last 4 decades. During this period, as you can see, there was a shift in the importance between tangible investment, such as property, plant, equipment, and intangible investment, such as patents, software, and other forms of intangibles. So since mid to late 90s, intangible investment has taken over tangible investment to become the most important type of investment in private sectors. From an accounting and reporting perspective, the rise of intangibles is a huge deal. On the US GAAP, as we all know, most expenditures on intangibles, such as R&D, branding, and organizational capital, are immediately expensed, whereas investment in physical and financial assets is capitalized. So the increase of intangible investment over time and the continuing practice of expensing intangibles under US GAAP, in our opinion, represent the most important force driving the persistent growth of loss reporting. Our objective in this study is to examine the implications of intangible investments for the value relevance of accounting loss information. Yeah, so in this study, we distinguish between two fundamentally different types of loss firms, GAAP losers versus real losers, by adjusting their reported earnings for the capitalization and amortization of all internally generated intangibles, including R&D, brands, and many others. GAAP losers are firms with negative reported earnings but positive adjusted earnings, and real losers are firms for which reported earnings and adjusted earnings are both negative. Adjustment for intangibles essentially reverses the expensing of intangible investments by treating them as assets and incorporating their capitalization and amortization into earnings information. We include SG&A expense in our adjustment because for most firms, this represents a much larger source of investment on intangibles than R&D expense. So this example from Pfizer shows how the company highlights its focus on multiple intangibles other than R&D, such as advertising, IT, brands, and so on. So this is how Pfizer highlights its focus on intangibles in explaining its $14 billion of spending on selling information restricted costs. By comparison, Pfizer's R&D expense of the same year was $8.6 billion. So this example explains how we classify loss firms. We follow common methods of intangibles capitalization and amortization to adjust the reported earnings of all loss firms. In this example, firm A and firm B have the same reported loss under GAAP. Firm A has positive adjusted earnings and is classified as a GAAP loser. Firm B, on the other hand, has negative adjusted earnings and therefore is classified as a real loser. When we apply this classification to all loss firms in our sample, we find that GAAP losers account for 35% of all loss firms. So GAAP-driven loss represents a large percentage of reported accounting loss. Okay, so here is a summary of our key findings. First, we find that the reported losses of GAAP losers are as informative as the reported earnings of profitable firms, when firms' internally generated intangibles are considered as assets. The same adjustment for intangibles, however, does not improve the earnings relevance of real losers. So GAAP losers and real losers are fundamentally different in terms of their earnings relevance. We also examine the relevance of liquidation option, which is a very important part of this literature on loss reporting. Our results suggest that GAAP losers do not face the prospects of liquidation, as these firms are more successful in creating value from technological innovation and human capital investment than other firms, including even profitable firms. In addition, we provide evidence on the future performance of loss firms. We find that GAAP losers definitely have better future performance than real losers. And GAAP losers even outperform profitable firms in recent years. For example, GAAP losers are less likely to decline and more likely to reverse their losses in future than real losers. So this is a very interesting finding, I think. So in essence, the key message from our results can be summarized by this quote from the great American playwright Arthur Miller, who once wrote, don't be seduced into thinking that that which does not make a profit is without value. I think this comes from his classic Death of a Salesman. Okay, so our study makes the following contributions to the existing literature on loss firms by improving our understanding about the continuing increase in loss reporting in recent decades and its implications. First, we examine an important and complex effect of reversing the expensing of intangibles by distinguishing between GAAP losers and real losers. And we find that contrary to the long-held view that losses are less informative than profits, the reported losses of GAAP losers are as informative as the reported earnings of profitable firms when firms' internally generated intangibles are considered as assets. We also show that liquidation option generally does not apply to GAAP losers. We find that GAAP losers are much more successful in technological innovation and human capital investment than other firms, including profitable firms. In addition, we provide new evidence on the future performance of loss firms. We show that GAAP losers definitely have better future performance than real losers, and GAAP losers even outperform profitable firms in recent decades. This evidence improves our understanding about the implications of the continuing increase in loss reporting in recent years. So next, I will show more details from our test of earnings relevance. So following the standard literature, we measure earnings relevance using earnings response coefficient estimated from a standard regression of stock returns on the level and the change of earnings. When we run this regression using reported earnings, our results confirm earlier evidence showing that the reported earnings of all loss firms, including GAAP losers and real losers, are substantially less value relevant than reported earnings of profitable firms. So this essentially confirms existing evidence in the literature and serves as our baseline result. However, when we include adjusted earnings in place of reported earnings in this regression, our results are very different for GAAP losers, but not for other firms. So the adjusted earnings of GAAP losers are highly informative and much more informative than the adjusted earnings of real losers. Interestingly, we find that the adjusted earnings of GAAP losers are also more informative than the adjusted earnings of profitable firms. For real losers and profitable firms, the value relevance of reported earnings versus their adjusted earnings is not significantly different. In contrast, the adjusted earnings of GAAP losers are more than twice as informative as their reported earnings. How much time do I have? 5 minutes? Okay, all right. So in this regression, we show that our results are the same even without directly using reported earnings. We find that without using adjusted earnings, when we regress returns on intangible adjustment items along with reported earnings, we find that GAAP losers have more informative reported earnings than profitable firms. This result is contrary to the existing evidence showing that losses are less informative than profits. Okay, so next we examine the relevance of liquidation option by comparing the value and the performance of firms' investment in technological innovation and human capital. We focus on intangibles because, as you have seen, our evidence so far indicates that intangibles are the key difference maker for earnings relevance. We consider two types of intangibles: technological innovation and human capital. So in technological innovation, we examine a bunch of indicators such as patent count, patent citation, patent lead time, as well as patent value. In all these tests, we find that, trying to go to the next slide, no, missed one. Okay, so I don't know why it's not showing up. Okay, here we go. Yeah, it's like, okay. Huh. Somehow there's one slide that refuses to show up. Okay, I don't know what went wrong. So I'm just going to explain what we find. Okay, so in this test, we find that GAAP losers definitely outperform real losers. in patent value and patent lead time. The same advantage also exists for gap losers when we compare gap losers with comparable profitable firms. So the conclusion here is gap losers are more successful innovators than real losers as well as profitable firms. So in the next test, we focus on human capital, and we have a bunch of indicators suggested by prior research as the forward-looking measures for the value and the performance of human capital. We find that gap losers have higher employee inflows, higher net employee additions, and more importantly, greater increases in net employee productivity in the subsequent year. And when we compare gap losers with profitable firms, pretty much the same conclusion holds here. Gap losers are doing better than human capital investment than real profitable firms. Okay, so this regression basically confirms our conjecture that gap losers' human capital benefits from employee turnover. However, profitable firms don't have this advantage. So in conclusion, our examination of intangibles indicate that gap losers are highly successful in innovation and human capital investment. And given how successful they are, liquidation and abandonment doesn't seem to be a rational option for the investors of these firms. So we confirm this interpretation with our evidence on the future performance of loss firms. So here we examine the likelihood of future decline value, future loss reversal, as well as future stock performance. So for the likelihood of future decline in value, we find that gap losers are less likely to decline in value than real losers, and we confirm the statistical significance of this difference in our logistic regression with an indicator variable for gap losers versus real losers, as well as control variables. Next, when we examine the likelihood of future loss reversal, we find a pretty much the same difference. Gap losers are substantially less likely to continue the pathway of decline. Instead, they're more likely to become profitable in the future than real losers. And we confirm the statistical significance of this difference with a logistic regression. In our last test, we examined future stock performance by providing evidence on 1 year ahead size-adjusted returns and abnormal returns estimated by using the Farmer-French 5-factor model. In both tests, we find that, again, I don't know what happened. Yeah, so in both tests, we find that gap losers consistently outperform real losers. There's no question about it. In all tests, in all periods. The returns for real losers are generally negative, which confirms their status as underperforming firms. And we also find that gap losers have higher future abnormal returns than profitable firms for the last 20 years. So the persistence of gap losers' positive future abnormal returns in recent decades is consistent with the underpricing of these firms and raises questions about investors' ability to see through standard earnings information that is distorted by the expansion of intangibles. So I'm going to conclude now. So in conclusion, the results of our study demonstrate that gap losses caused by the expensing of intangibles are fundamentally different from real losses that occur irrespective of the expensing of intangibles. We find that contrary to the long-held view claiming the informational irrelevance of accounting loss, gap losses are highly informative and are in fact as informative as the reported earnings of profitable firms. Importantly, we also find that gap losers' investment in intangibles, which directly drive their reported accounting loss, actually create more success in technological innovation and human capital for these firms. Our results further demonstrate that gap losers definitely have better future performance than real losers, and they also outperform profitable firms in recent decades. So taken together, our results indicate that standard accounting reports of gap losers seriously distort the intrinsic value and the performance of these highly dynamic and innovative firms. This is all I have. Thank you very much.
Excellent. Thank you, Feng. The discussant will be Anup Srivastava from University of Calgary. Anup, you have 20 minutes.
So I'll wait for my slides. All right, thanks to organizers for inviting me. A great presentation, Frank. I like the paper. I've been watching this paper for quite some time. I'll not go into details of each hypothesis or empirical results. I'll provide a different perspective on losses, and that's why I call my presentation as losses and not the long title that Feng used. So let's see. That way, right? Pointing to the back. Okay, missed the colorful slide. Okay, all I will say is that all losses are not red in color. They come in different shades. They come in different varieties. And if there is one thing that you should take away from my presentation is this slide. And I'm going to explain that in a couple of minutes. It's a very important development that has happened over a period of time. Next slide, please. All right, so let's go back to the genesis of income statement. And mid-1930s, SEC mandates public corporations, US public corporations, to report income statement on a periodic basis. And presumably the idea was that the profits, the bottom line figure, should represent the economic income earned by the company during a period of time, right? And there are several different definitions of economic income out there. One of them is by Hicks. Again, next slide. Next is the amount that a company can pay out as dividends while leaving the company equally well off, right? Next slide, please. But how do we calculate profits? And so some conventions evolved. Convention was, let's have revenues minus expenses, and we'll have profits. So next, revenue is based on delivery and collectability. It has its own issues. For modern technology firms, many value relevant events cannot be recognized in revenues. Lyft is headquartered here. I saw this on my way from airport. If Lyft signs up with another 1 million car drivers, it's a huge value creating event for the company, not recognized as revenues. Biotechnology firm goes from phase 2 to phase 3, FDA approval, not recognized as revenues. So it has its own issues. We'll talk about it some other time, but let's focus on expenses. Next one, please. Now, expenses are recognized using different conventions. So let's just recall some of them. First one is cost of goods sold, typically matched to revenues. Another one, important one, discussion topic today is R&D and intangibles, where costs are expensed as incurred. We have something called stock options, which is based on past and future data. We have some formulaic expenses, truck depreciated over 5 years, irrespective of revenues, some time-based expenses, such as loan interest payments, some expenses recognized in anticipation of future payouts, and some catch-ups like impairments. Why I bring this up is that my undergraduate is in engineering, and I was told that when you're trying to design something, at least try to have them on a common theoretical framework. If you're trying to build a bridge where one foot of the bridge is measured in meters, another one in kilograms, another one in pounds, another one in nanometers, another one in microseconds, the bridge is not likely to be good. And so what we have as profits is actually a net result of multiple conventions we use in accounting. And this is not a new issue. So next slide, please. Next one. So I have a paper out here, a paragraph out here, which all of us have read. And trivia question, guess which paper it is, right? So accountants have to deal with consolidations, leases, mergers, R&Ds, to name just a few problem areas. Accounting lacks an all-embracing theoretical framework, and dissimilarities and practices have evolved. As a result, net income is an aggregate of components which are not homogeneous. Foot, pound, kilometers, nanometers, microseconds. It is thus alleged, so this is earnings. Earnings is thus alleged to be a meaningless figure, not unlike differences between 27 tables and 8 chairs. Which paper is this? Ball and Brown, 1968. So this is, next slide, please. This is not a new paper. This is not a new idea. It has been around for quite some time. And let's go even back. Next one, please. 1929. something that is cited in Ball and Brown. What is set out as a measure of net income can never be supposed to be a fact in any sense at all, except that it is a figure that results when an accountant has finished applying the procedures which he adopts. Some procedures for revenues, some procedures for expenses, and we get something as bottom line. So it is alleged that it is a meaningless number. Issue has been around since 1920s. Next slide, please. But despite that, this is what we found. The most famous figure, at least capital market research, that profit firms on average have positive returns, loss firms on average have negative returns. So the question is, what has happened over last 40, 50 odd years? Next slide, please. Anyway, what has happened since 1968? So I'll try to throw some light with some descriptive data. Next slide, please. Now, we don't talk about something called matching, but without matching, accrual income is not a useful metric. Many of us teach FSA, I teach FSA. Without matching, what do I do with profits? What do I do with profit margin? Can I use that profit margin to predict future profits? Can I use the current profits to predict future profits? No, I cannot. So this makes intuitive sense. Next slide, please. So let's see what has happened to matching over time. And I use a simple design. I do that in one of my JE papers, where I divide all firms into different cohorts, listing cohorts based on decade of listing. So firms listed before 1960s, 60s, 70s, 80s, 90s, first decade of 2000, and the second decade of 2000. And as you can see, that the matching for traditional firms still remains pretty high. Click, please. It's still 1:1. And this is not a life cycle effect. I'm going to prove it to you. It's not a life cycle effect. But when you look at firms listed in last 30 years or so, matching is very low. 60, 70, 80, 90% costs are not matched to revenues. Next click, please. That's you can see. And I'm going to explain what's going on here. Next slide, please. So let's contrast a 21st century firm against a 20th century giant. Let's keep a Ford or a General Motors here and a Lyft or Airbnb or LinkedIn or Facebook here. Does Facebook have land, building, machinery, plants, warehouse, inventory? No, it doesn't. These are its most important investments. It's a business idea. It is organizational strategy. It is first mover advantage. It's capturing customers, customer and social relationships, so on and so forth. All those investments are reported in something called as SG&A, which Feng brought, but I'm going to bring it again. Next slide, please. So cost of goods sold. We know cost of goods sold. It is the physical cost of production, energy, production labor, so on and so forth. And we had something called as SG&A, which was an incident category of costs, where if we didn't know what to do with it, we put it in SG&A. But over a period of time, the most important costs for the companies. Think about Facebook. Does it have cost of goods sold? Google, LinkedIn? Where are its most important costs? In SG&A. Now, why is it important? Next slide, please. If you look at matching of cost of goods sold, or cost of sales, or cost of revenue, whatever you want to call it, it is still perfect, 1:1 for all cohorts. When you look at SG&A, for last 3 cohorts, firms listed in last 30 years, matching of SG&A is close to 0. Next slide, please. So again, just pictorially representing perfect matching, and a 0 will come up here. Come. Next slide. Okay, perfect matching, SG&A, and now 0. Come on. Here it is. All right. So SG&A, the matching of SG&A is close to 0. Next slide, please. Now, again, why is this important? Let's look at each cohort, and let's look at changes in cost patterns. And again, this is not a life cycle effect. I'm going to show it to you. Clickers, please. 2 clicks. One more. All right. Cost of goods sold is declining for each successive cohort. SG&A is increasing for each successive cohort. And now these lines have crossed. Okay. Clicker, please. It is not a life cycle effect because all of the data is measured when the firm is 3 years old. If you don't believe in this data, next slide, please. I'm sure you recognize these firms. You can eyeball them. Pretty familiar companies. For all of them, SG&A exceeds cost of goods sold. Next slide, please. Another measure, SG&A exceeds cost of goods sold. For each successive cohort, a greater proportion of firms have more SG&A than cost of goods sold. Next slide, please. Let's talk about loss firms, which is the title of today's discussion. Last 3 cohorts, firms listed in last 30 years. SG&A exceeds cost of goods sold. Right? Next slide. Now let's combine these 2 facts. First fact, first click, please. SG&A exceeds cost of goods sold for firms listed in last 30 years. Next slide. And SG&A matching is close to 0. So just keep this in mind. SG&A exceeds cost of goods sold. That's a predominant cost, and its matching with revenue is close to 0. So what do we get? Next slide, please. This is what the income statement structure looks like. The most important cost, most important operating cost, is not matched to revenues. So what you get here as a bottom line, of course, is not useful for valuation. Next slide, please. And this was a colorful graph that I wanted you to take away. This is the changing composition of firm population. So the lightest blue is the firms listed before 1960s. They're only 2% of firm population today. Firms listed in 60s are about 1 or 2%. Firms listed in 70s are just 2 or 3%. Clicker, please. Firms listed in last 30 years is the predominant presence in today's population. More than 80% firms were listed in last 30 years. What kind of firms were listed in last 30 years? Are they more likely to be a LinkedIn, or they're more likely to be a General Motors or Ford? Clicker, please. And firms listed before 1990 are pretty small percentage. Next slide, please. And this is the pie chart, the same thing. 3 more clicks, 1, 2, 3. All right, firms listed after 1990 is 80% plus. 80% plus, what are the characteristics? High SG&A and unmatched SG&A, which means bottom line is not so useful for value decisions. Next slide, please. This is a paper with Luminita. Feng provided a Corrado and Hulton, which is an economics paper, macro paper. This is at the micro level. Firms' largest investments are not in PP&E anymore. When you look at operating investments, US firms, their real investments is in soft capital. So we define something called as main SG&A. We remove R&D, we remove advertising, and whatever is left is main SG&A. We divide that into a consumption component and an investment component. So the investment component of main SG&A is the real investment for US firms today. This is the largest category. Next slide, please. Now, this does not mean that all elements of income statement are useless. Mary Barth is here. I saw her. Yeah, she's there. She has a paper with Charlie McClure. There are other components in income statement that are highly value relevant. Revenue, the most important value relevant item for modern companies. When you have marginal cost is 0, winner takes all profits, then what is the most important thing? The drivers of revenues. Facebook subscriber growth is increasing, $1 trillion valuation. Subscribers growth starts declining, 2/3 valuation wiped out. Profits still the highest ever, right? So revenue, investment SG&A. I have paper with Baruch and tons of finance papers show that this is the most important expense item or outlay or investment. R&D, highly value relevant. Next clicker, please. But by the time we reach, after we have applied all the procedures, by the time we reach bottom line, not sure. Next slide, please. And this is also evident from companies' behavior. They produce a bottom line number just because SEC requires them to. And some of them are reported as losses, which Feng finds are not that value relevant. Clicker, please. 90% plus firms report non-GAAP earnings. They report something and they undo and they come out with something and they say, look, this is not our bottom line. Something else is our bottom line. Next slide, please. And this paper surprised me. If you haven't read it, go back and read it. I saw Suresh here somewhere in the room. Suresh, Mani, and Mohan have this paper, which actually challenges our basic assumption. The whole idea of accrual earnings was it will help us predict the future timing, amount, and certainty of future cash flows. And this paper actually shows that you are better off using cash flows to predict future cash flows than earnings, because the predictability of earnings, the blue line, is actually lower than cash flows. The bottom line has become so noisy that it is not useful for predicting future cash flows. Next slide, please. So I'm going to conclude and leave this as a food for thought from a thought piece by my colleague, Phil. Clicker, please. 5 or 6 clicks, 2 or 3 clicks. Okay, let's stop here. Should we have bottom line reporting as a voluntary reporting? Because there are, if you don't have it, there'll be some savings on preparation, audit, and most importantly, comprehension. Because we still think loss is a loss. Feng's paper show it is not a loss. It is actually something that has resulted from applying accounting procedures. It is not that meaningful anymore versus loss of information value. So Phil actually argues that let it be a voluntary process. For companies like Walmart, ExxonMobil, let them report bottom line number because it is a meaningful figure. For other firms like Airbnb or for Uber, let it be a voluntary process. Next slide, please. And it's very easy for me to criticize things. I wrote a paper, a thought piece with Shiva Rajgopal, where we do provide a blueprint for digital companies' financial reporting, and the bottom line reporting does not appear anywhere in our recommendation. Last slide. All right, thank you for listening to my concluding thoughts. Thank you.
All right, thank you so much, Anup. And then Feng, let's open it up to the floor for questions. I'll direct the microphones, and then if you could introduce yourself and ask your question, that would be great. I thought we'd actually start off with a question from one of our colleagues online, though. So Eric Weisbrod from University of Kansas wants to know about a Dhaliwal et al. Paper in 2012, which finds that book losses are less persistent when a company reports positive taxable income. So here's a situation with book-only losses, similar to your GAAP-only losses. So do you think that this phenomenon in yours could be correlated, in which there are some GAAP losers reporting positive tax expense or taxable income? If so, it might be useful to understand the incremental signal coming from your measure.
Okay, so I'm not an expert on tax accounting, but based on my understanding of this question, I think there is a good possibility that there may be some overlap between these two phenomena. So before I can answer that, more positively, I think I probably need to go back to check the data, and maybe this is something we can think about in sort of explaining or overlap with other studies in the area, because I do think it's a relevant question.
Great.
Yeah, hi, my name is Shiva Shivakumar. I'm from London Business School. It's an interesting paper, but one of the things is you are claiming it's all to do with R&D and SG&A capitalization, but you do not nail it to R&D and SG&A capitalization. In the sense, if I were to repeat your analysis by capitalizing cost of goods sold, rather than capitalizing, maybe this might be the point that Anup was also trying to say. But my question is, if you try and capitalize other expenses, will you still get a similar result as what you have got? In which case, it may not be just due to R&D, it might be due to some other things, all these expenses, each of them being value relevant in a very different way. But that's something you can show, whether it's specific to the capital adjustments that you have made or not. And in fact, Rob was telling me in a very similar point. Maybe it's also to do with the fact that R&D expenses are largely cash expenses, whereas some other expenses might be the accrual expenses, and you are capitalizing some of these cash expenses, which could be leading to the results that you're showing right now.
Okay, yeah, good question. So first of all, we're not suggesting that we should capitalize all expenses. No, that's probably called fraudulent accounting, right? So we're only capitalizing R&D and SG&A based on prior research showing that some, not all of them, of these expenses lead to future benefits. On the other hand, cost of goods sold is entirely different. It's perfectly, as Anup pointed out, it's perfectly matched to sales revenue of the same period. And even with new cohorts of companies coming to market, the match quality is still very good. So in that sense, cost of goods sold is only restricted to the current period of time. And once we move beyond the current reporting period, it has no relevance for the future value, such as cash flows of the company. So we're not suggesting we capitalize everything. Now, going back to your question, if we don't capitalize R&D and SG&A, would we still get the same result in the sense that some of these loss firms are actually better than other loss firms? The answer is definitely yes. How do I demonstrate this? I know the idea of capitalizing something, amortizing it over multiple years, sometimes it's controversial. Some people may not like the idea, think it's too risky, not reliable enough, not conservative enough. I get it. So another way of demonstrating what we're documenting here is to look at the classifications of all loss firms along two dimensions. Okay, if you really understand the mechanic effect of capitalization and amortization, what we're doing here is to identify a set of firms that have two different characteristics. One is reported earnings, all negative, but some numbers are more negative than others. That's one dimension to cut across the sample. Another dimension is the amount of R&D and SG&A expense. So if we sort the sample firms of all loss reporting firms by these two dimensions, look at, for example, 5 sorts based on intangibles expenditure, investment, and 10, 11 sorts based on reported earnings, from the most negative to the least negative, again, all negative, and sort of look at the two corners. The upper left corner, is populated by firms with the most negative earnings and the smallest amount of intangible investment. And the lower right corner is populated by firms with the least negative earnings and the highest amount of intangible expenditure, right? So the firms in the upper left corner is what we call real losers, in the sense that even if you somehow allow them to capitalize R&D expenditure, SG&A expenses, because their earnings are already so negative, the effect of capitalization is not going to overcome to make the earnings to be positive. On the other hand, the firms on the lower right corners are exactly the opposite. So we call them the gap losers. Again, without using capitalization, amortization, just a very simple two by two sorts for the samples we have, we got exactly the same results.
We'll take next question.
Okay. Thanks. I think this is an interesting paper, and it's sort of nice because it ties into often what I tell my undergrads when I'm teaching them about capitalizing versus expensing R&D. But one thing I wondered when you're breaking apart these groups is, what else could possibly be driving your results? You're always wondering that with the paper, and how many of these real loss firms are just firms with negative gross margin. And when you have negative gross margin, that's sort of like, every time you do anything, you're making a loss. It's sort of something kind of inherently different. And then on the other side, once you've pulled out those negative gross margin firms, there are other reasons why firms may be choosing to have a loss in any given period, because managers have private information about their future prospects. So if they're expecting in the future for things to go well, then they're willing to take a loss this period because then they know that they're going to make it back. And so just wondered to what extent you could sort of tease out some of that.
Okay, great question. So there are two factors you're suggesting. One is the role of gross margin, positive versus negative gross margin. The other one is gross prospect. Let's say I'll call it sales growth. For sales growth, we actually mentioned in the paper, it's probably in one of the footnotes because we get this kind of question all the time. Some people think this is driven by growth phenomena, that some of the firms have higher growth rate than others. We actually control the growth rate directly in some of our tests. For example, the earnings relevance test, we included the growth rate of sales revenue as a proxy for that phenomena, and our results are basically the same. And then I think in the reversal of future loss and then the likelihood of future declining value, we also included similar variables to capture that. Our results don't change very much. So I don't think it's driven by sales growth. Back to your question about gross margin, we haven't checked it. I think it's a great question. Maybe at the end of the day, some of the real loss firms have more frequent periods with negative gross margin than the gap losers. And we probably can take a look at and see to what extent this may play a role. My hunch is even after we control for that, the intangibles are still going to have a very important effect.
I think there's another question at the same table. Did you have a question? Yeah.
Oh, yeah. Hi, this is Ayon Tan from Georgetown. So I'm 100% kind of like trust or convinced of your evidence. I think my question is about how do we interpret the results? We just talk about movie industry, so I like catchy labels. So like gap versus real losers, right? But ex ante, all your simple firms have to adopt US GAAP, right? So ex ante, they know the rule is to expensing all the intangible asset investments. Ex post, you partition your sample based on how much they actually make investments, intangible asset investment in the current year, exceeding some of the black box threshold based on the industry specific amortization. So my question is that, are we comparing firms investing aggressively in intangible asset investments compared to the less aggressive investors? And we find results that somehow, given there's a threshold, you invest substantially more, you are going to be more productive in terms of innovation in the future, and then you will have a higher stock values in the future. And if you don't invest enough, then you are real losers. I just want to know that whether the study is about the investment story or is actually teaching us something about accounting for intangible asset investment.
Yeah, great question. I think this has something to do with both. As you mentioned, investment in intangible assets is definitely very important. That's what we're trying to capture in this study. However, if you think about the mechanics of how to classify our loss firms into these two buckets, the real losers have negative adjusted earnings because not just because they don't invest as much, it's also because their earnings are already very weak to begin with. So even if they have a modest, let's say industry average amount of investment in various intangibles, once we capitalize, amortize everything, they were still going to report negative earnings because their fundamentals are still on the weak side. The gap losers, on the other hand, they probably invest more, but even when the investment rate is just at industry average, if they already have some sort of track record, stronger sales, maybe more positive gross margins and other positive factors, they will have positive adjusted earnings. So it's about both effect. First, you have to invest aggressively, and we're not the first paper to document this. Anup, in his discussion, alluded to this effect, which has been documented for quite some time by studies in finance, accounting, and economics. Secondly, the second point, which we care more, is about the accounting story here.
Thank you. Kristen Valentine, University of Georgia. I think had a very similar question, actually. I think key to the punchline of the paper is that gap losers and real losers are different because gap losers have better outcomes, right? And one of those you look at are innovation. But again, I would have appreciated some descriptives on whether gap versus real losers have different levels of R&D investment, which of course would be correlated with their patenting outcomes. And part of that was, I wasn't quite sure, actually in the table you didn't get to pull up. You match for when you're on the level of R&D investments and when you're comparing gap losers to profitable firms, but not when you're comparing gap losers to real losers. So I was confused by how we're supposed to interpret that. Like, am I supposed to think that you're holding constant the level of input and then looking at variation in the output of innovation? And if so, then why not match when comparing gap to real losers?
Okay, good question, very good question. I remember at the early stage of this project, we also did the same matching. So you're talking about the matching between gap losers and real losers by firm size, total R&D spending, and so on. Of course, every time when you do this kind of matching, you have to be a little bit concerned about the feasible sample size. But with that aside, I remember when we look at that, we did see similar results, especially in the actual value of patents. So in some comparisons, we actually saw that some of the patents produced by the real losers actually have pretty high scientific value, which is captured by the patent citation index. But once you move into the commercial area, the actual value of these patents just don't match up with the value of patents produced by gap losers. And we sort of saw the same thing in human capital investment as well. Maybe we're going to add a footnote in the paper to just indicate. But somehow we decided, the comparison between gap losers and real losers is not actually the most interesting side of the study. Once you have gone through the stage of discovering, yeah, they're already so different to begin with, so who bothers? We wanted to spend more time comparing gap losers with profitable firms because in an economic sense, these gap losers are truly profitable. So their comparable peers should come from the set of profitable firms instead of real losers. So that's why later on in the paper, we focus a little bit more energy in comparing gap losers with similar profitable firms.
All right. So I think with that, we're going to be able to end the session right on time. So big thank you to the author, the discussant, and all of you for your great questions.